Welcome, everyone, to today's Explainer. We're unpacking a fascinating and honestly slightly terrifying viral theory that's been making the rounds on Reddit. It makes a really bold claim. It suggests that the stock market, mathematically speaking, can literally never fall again. I mean, with markets hitting dozens of all-time highs recently, this idea is catching like wildfire. But is it just internet hype, or are we witnessing a fundamental shift in how wealth is generated and protected? Well, we're going to break down the exact data behind this theory using the source material to see what's really going on under the hood. Okay, let's dive into our roadmap for today. 1. The viral melt-up theory. 2. History's great melt-ups. 3. The debt and inflation connection. 4. Fact-checking the internet claims. 5. The financial repression reality. And finally, 6. Building a safe exit plan. Section 1, the viral melt-up theory. Let's look at where this whole thing actually started and why it feels so incredibly believable right now. Listen to this exact quote from the viral thread. "Stonks go up is no longer a meme, it's a law, like gravity." Honestly, that perfectly captures what a lot of investors are feeling today. When you look at the headlines, AI stocks are constantly ripping to new all-time highs. It can feel a little weird, almost like the market is totally detached from reality. When everything just keeps going up, people start to genuinely believe that the old rules of finance have been permanently rewritten. So that brings us to the central, super provocative question driving our explainer today: will the stock market literally never go down again? The theory argues that because of massive government debt and inflation, the system is designed to only move upward in dollar terms. But before we just accept that as absolute fact, we really need to understand the economic engine behind these massive market runs. To grasp what's happening, we've got to define a concept economists call the Great Meltup. Basically, this is the final, completely euphoric phase of a bull market. In a meltup, prices aren't driven by boring things like corporate earnings or business fundamentals anymore. Instead, they're driven entirely by momentum and FOMO, the fear of missing out. It creates this overwhelming feeling that everyone around you is getting incredibly rich just because they're buying in, and prices keep rising simply because they've kept going up so far. Section 2, History's Great Meltups. Has this kind of euphoric, gravity-defying market ever happened before? Let's pivot from the current hype to the cold, hard data of the past. And this brilliantly illustrates that meltups are actually surprisingly common, but they follow a very distinct pattern. Look at the 1999 dot-com bubble here in the US. The NASDAQ ran up 400%. Investors truly believed the internet had permanently changed the financial laws of gravity. But then came the crash, a brutal 78% drop that took over 10 years to fully recover from. Or look at Japan in the 1980s, a staggering 900% run-up followed by a 60% crash that took an agonizing 34 years just to break even. The takeaway here is absolutely crucial. Meltups don't stop because the underlying idea, like the internet, was bad. They stop simply because eventually there's literally no one left with the cash to keep buying in higher. Section 3. The debt and inflation connection. If history proves that meltups always crash, why is the internet insisting that this time is different? $40 trillion. Let that sink in. That staggering number is the very foundation of the Reddit theory. The US government is approaching $40 trillion in debt, and we are currently running a $2 trillion annual deficit, meaning we consistently spend way more money than we take in. The viral theory asks a pretty logical question. How can the government possibly get out from under this without completely collapsing the economy? The answer, the theory claims, is that they have to inflate it away, essentially destroying the purchasing power of the dollar so the debt becomes cheaper to pay off. But here's where the warning lights really start flashing. This number, 40, is the current CAPE ratio of the stock market. Now, the CAPE ratio is just a metric that measures how expensive stocks are relative to their long-term earnings. A ratio of 40 is dangerously high. To put that into perspective, in the last 140 years, it's only ever been above 40 twice, right before the 1929 Great Depression and at the absolute peak of the dot-com bubble. So the market isn't just pricing in a bit of inflation, it's currently more expensive than it was heading into the 2008 financial crisis. Section 4, Fact-checking the internet claims. Now that we've seen the immense scale of the debt and just how expensive the market is, let's impartially fact-check the specific claims made in this viral theory. The first major claim in the viral post is that U.S. interest payments are about to exceed the entire U.S. GDP. Okay, actually, scratch that. This is completely false. What they likely meant is that the debt-to-GDP ratio has exceeded 100%. And while that sounds incredibly scary, history proves it's not an immediate death sentence. As the reality check shows, the U.S. actually hit this exact level back in the 1950s after World War II. And you know what? The government successfully managed it, eventually seeing the market completely recover and rip higher. Claim number 2 is that the only way for the government to make its interest payments is to physically print more money. We all love the image of a magical money printing button swooping in to save the day, but yeah, it's a myth. In reality, the government borrows the money it needs by selling U.S. treasuries. They sell these to everyday investors, giant pension funds, corporations, and even foreign governments who just want a stable, guaranteed return. While constantly borrowing isn't sustainable forever, saying we just print money skips over the actual real-world mechanics of how debt is funded. Now, what's really interesting here is how the facts completely dismantle the most dangerous assumption of that entire Reddit post. The theory claims that if hyperinflation hits, you shouldn't care as long as you own stocks, because the stocks will just inflate proportionally. But the reality, it's far more brutal. Historically, hyperinflation absolutely destroys your real everyday purchasing power. It often forces people to sell their stocks at the absolute bottom just to afford basic necessities, like rent and food. Let's look at the actual historical receipts on extreme inflation. In Germany, from 1918 to 1922, the stock market lost 97% of its value before inflation peaked. In Zimbabwe, the stock market skyrocketed nominally, but actually lost 99.8% of its value when measured in US dollars. Venezuela in 2018 saw stocks post a massive 22,000% return, but the actual economy shrank by 50%, leaving citizens progressively poorer. Even right here in the US during the 1970s, we saw inflation average 7% a year. Yet the stock market delivered a flat 0% return after adjusting for that inflation. Holding stocks during high inflation simply doesn't magically protect your wealth without consequences. Section 5, the financial repression reality. If hyperinflation and a total market collapse aren't the answer, what actually happens next? Let's dig into the most likely scenario. Based on historical data, the U.S. is highly unlikely to default or experience true hyperinflation. Instead, we're looking at a strategy called financial repression. Think of it as a quiet, decades-long strategy where the government lets inflation run just a little bit higher than interest rates. Over time, this slowly devalues the national debt, making it much easier to pay back. It's not dramatic. It doesn't make breaking news. It's just a slow burn in the background that quietly squeezes savers until one day a fast food hamburger eventually costs $35. And because of that slow burn of financial repression, this next concept is absolutely vital to understand. Yes, asset prices and stocks will likely continue to drift higher in dollar terms. But after accounting for inflation, your real returns, your actual purchasing power, could be significantly lower than what you're expecting. The market might hit a brand new all-time high, but if the cost of living has doubled, you won't actually feel any richer. Section 6, building a safe exit plan. We've covered a ton of ground today, from viral hype to sobering history. So how do you actually protect your wealth in this environment? So, the crucial point is this. The viral Reddit theory is directionally right, but it is mechanically wrong. It's directionally right because, yeah, in a high-debt world, inflation will likely continue. And over the very long term, that does favor holding assets like stocks over holding cash. But it's mechanically wrong and incredibly dangerous to believe that the market is mathematically immune to crashing. Stocks can absolutely still fall 40% or 50% along the way, even if they eventually recover to new highs way down the line. To survive and thrive in this kind of market, you need a solid plan. And the historical data points to these 4 key strategies. First, keep a steady income stream so you're never forced to sell assets just to pay the bills. Second, stay diversified. Please don't go all in on one viral trend or sector. Third, always hold some cash on the sidelines so you have a buffer and can buy when assets go on sale. And finally, maintain a margin of safety, meaning avoid heavy leverage or margin debt. The people who survived and built wealth through past crises, they were patient, steady investors, not the ones who bet their entire future assuming a government bailout was guaranteed. Which leaves us with this final, thought-provoking question to ask yourself as you look at your own portfolio. If the market falls 40% before hitting its next all-time high, are you positioned to survive without being forced to sell? It's so easy to get caught up in the melt-up mentality when everything is flashing green, but true wealth is built by those who are prepared for when it's not. Don't base your entire financial future on a viral post. Look past the hype, assess your real risk, and make sure your portfolio is built for reality, not just the best-case scenario. Thanks for joining me on this explainer, and we'll see you next time.